Okay, modeling uncertainty sounds impressive, but it's a bit abstract. I need something concrete. And this is where EduKnit uses that really unexpected analogy.
The traffic accident analogy.
Let's get into it.
It's brilliant because it takes money out of the equation to explain the method. Sometimes money confuses people because they have emotional attachments to it. Traffic is just traffic.
Okay, walk us through this. How does road safety explain the CFA and high finance?
Imagine you want to measure the risk on a specific stretch of road. You are a scientist or maybe an insurer.
Okay.
You want to understand why accidents happen there. Maybe you want to know if it's safe to drive on or if you should insure cars driving on it.
Okay, I'm picturing a busy intersection. Cars, noise, maybe a confusing sign, people honking.
So in statistics and in the scientific method, we have something called the dependent variable.
The dependent variable.
This is the outcome we want to explain. In this case, it's the number of accidents.
Got it. The number of accidents is the what? It's the thing we're trying to figure out.
Exactly. Then we have the independent variables. These are the factors that might cause the change in the dependent variable.
The potential causes.
Right. So think about it. What might cause accidents on that road?
Well, traffic density. If there are more cars, there are probably more crashes.
Good one.
Whether there are traffic lights or stop signs,
Mm-hmm.
maybe people using their phones, is it raining, the lighting conditions, the quality of the asphalts, the speed limit.
Exactly. All of those are variables. Now, a quantitative mind, the CFA mind, doesn't just guess.
Right.
They don't just look at the road, stroke their chin, and say, looks dangerous, Bob. I'd stay away.
I get a bad vibe from this highway.
Right. No vibes allowed. They use statistical models. They gather massive amounts of data on all those variables.
For like years.
For years. And they run it through models like multiple linear regression or Poisson regression.
Whoa, okay, dropping the regression terms.
Mhm.
I haven't heard Poisson since college stats, and I think I suppressed that memory.
It sounds complex, but it's just a way of mathematically weighing those factors. The model might tell you, hey, 60% of the accidents here are correlated with poor lighting, and 30% are correlated with speed. And the rain actually doesn't matter as much as you thought.
So the model sorts out the signal from the noise.
It tries to. So the result isn't an absolute truth. It's not, God says this is why.
It's a probability.
Correct. It is the best statistical explanation based on the available data. That is the essence of the quantitative mindset. You are building a model of reality to explain outcomes.
Okay, I get the road safety. It makes sense. You use data to predict risk. Now, bridge this back to the CFA. How does this apply to my investment portfolio?
It is the exact same philosophy, but now switch the variables.
Okay.
The dependent variable, the thing we want to explain, is the return on an asset.
Instead of accidents, we are looking at profit. Why did this stock go up? Why did this bond go down?
Right. And instead of traffic lights or rain or speed limits, our independent variables are things like market risk.
The whole market going up or down.
The size of the company, value factors, interest rates, inflation.
Ah, okay. So we're asking, did this stock go up because the whole market went up, or because it's a small company, the size factor, or because it was undervalued, the value factor?
Exactly. And the models used in the CFA curriculum, things like the CAPM, the capital asset pricing model,
Say right.
multi-factor models, the Fama-French three-factor model, asset pricing theory, these are just the traffic models applied to money.
That clicks. That really clicks. So CAPM isn't just a formula to memorize to pass a test. It's a regression model trying to explain why a stock moves.
Yes. And this brings us to the core distinction. While an accountant is recording what actually happened, we spent $50 on traffic cones.
A historical fact.
The CFA is modeling what might happen based on statistical relationships.
Accounting records history. CFA models probability.
And that is why they're different professions. EduKnit compares it to a heart surgeon versus a civil engineer. Both are highly educated, both deal with complex systems, but you wouldn't ask a civil engineer to do a bypass.
And you definitely wouldn't ask a heart surgeon to build a bridge. It would probably be a very messy bridge.
Precisely. CFA doesn't teach advanced accounting in the way an ACCA does. And accounting doesn't teach quantitative modeling in the way CFA does.
They're just different toolkits for different jobs.
They are neighbors, but they live in different houses, speak different dialects, and wake up with different goals.